but everything could be explained by the balance of the supply of money to the demand of money. So let's assume Chris Berg wants a loan on his house, right? And and every lender in the country believes Chris Berg is the finest borrower that lives. And so they're all beating a path to your door. The balance of power is squarely in your hands, right? And you're going to hold a competition amongst all of those would-be lenders, and you're going to squeeze them to, and you're going to ultimately select the lender who's willing to lend you the most proceeds at the lowest rate with the least protective covenants. And because you have the balance of power for negotiation squarely in your camp because of the preponderance of competition chasing you, that loan is likely to be a poor performing loan. Either they will have lent you too much money and you won't be able to repay it, or they will have very lax terms that will enable you when times go bad to not even make your payments and they won't have the rights to foreclose that are typical in a well structured loan. Or at the very least, even if your loan performs, they will have earned an inferior rate of return by virtue of the fact that they had to compete so heavily. Now, if you take the opposite scenario where Chris Berg has filed for bankruptcy 10 times and is generally considered to be the worst borrower in the state of California. Well, when you go for a loan, literally nobody's at your door. Nobody's answering that call. And so in kind of direct opposition to that first example, if I show up and I'm willing to talk to you about making you a loan, you're going to just take anything I offer. The proceeds are going to be conservative, the rate's going to be high, and my lender protections and covenants are going to be unbelievably strong and favor me, the lender. And you're just going to have to take it because there's no competition. And so the balance of power resides with the lender in a moment when there's no competition. And that summarizes cycles.